Welcome to Get Out of Debt for Good, Lesson 11, Insurance. Buckle up, folks. This one's going to be a little hard. Let's get going. Let's do this thing. All right, I'm going to share my screen here. Here we go. Lesson 11. Before you start this lesson, you should have a few things. You should have your budget that you're tracking or tackling, right? You should have a decision on whether you're pursuing a side job or a side hustle. You should know that. And you should have a decision on whether you're making a big change in your financial situation or not. So those were the food costs and the essential expenses. You should know what you're changing and how. Okay. This lesson, hold on. So I did want to just remind you, like always, please remember to take any questions to your group financial coaching sessions. You get 2 per month for the 6-month subscription. At this point, you've honed your budget. You know whether you're working to get another income, and you've decided whether to make a big change in your living situation or not. You know how to budget, and you're starting to really pay off some debt. You are changing your life. So now let's talk about insurance. So insurance is your best defense to make sure you never get into debt again. That's right. Insurance is your best defense to make sure you never get into debt again. We're going to go through why, what it is, all of that stuff. We're going to go through essential insurances. We have a lot of bonus videos in this unit, in this section. So watch them if you're curious or if you need to. All right. So let's go through what insurance is. Insurance is when you pay a little bit of money to a company, which then that company gives you protection against a possible future event. Insurance is when a company gives you financial protection against a future event that could have a catastrophic effect on you. So insurance is really, it's just paying for financial protection. Okay. And there are all different kinds of insurance. There's a bunch of different kinds. Depending on your situation, you may or may not need all of these. Now, everyone needs health insurance. Everyone needs either renter's insurance if you rent an apartment or home, or homeowners insurance if you own your home. If you have a car, you need car insurance. Everyone who works needs a kind of disability insurance, okay? Long-term disability, and some people need short-term disability insurance. We're going to get into that. Not everyone needs life insurance. And there are lots of different kinds of life insurance that get sold everywhere and often. So let's dive into insurance. Okay. We're going to focus on a few different kinds of insurance in this section, these kinds. I have some handouts that will help you walk through these, but please take notes and pay attention because insurance can get a little confusing. It's a bunch of financial rules and responsibilities, a bunch of finances. This is your best defense against getting into crippling debt, either for the first time or again. So let's do this. According to Investopedia, health insurance is a type of insurance coverage that pays for medical and surgical expenses that are incurred by the insured. Let's demystify that. That just means that health insurance will pay for your hospital bills, your doctor bills, if something happens. Okay. It's a type of insurance coverage that pays for medical expenses when something bad happens. Get it? Health insurance is something you pay for that will pay for medical expenses you have. And a lot of people will say things like, I'm young, I'm healthy, I don't need medical insurance. Well, guess what? I had my appendix out at 24. I was young and healthy. You know, people have heart attacks. People go to the hospital for different reasons. Health insurance will save your butt. Let's talk through an example. Let's say Bob has a heart attack or he breaks his femur, God forbid. All bills together would be close to $150,000. And I've actually seen medical bills for something like this for closer to $450,000 and some over $1 million for like a NICU stay. Okay. Health insurance should not be optional, even if it costs you $1,200 to $1,800 per month. We'll figure out the cost in your budget. Would you rather pay for health insurance or would you rather pay for a $1 million NICU stay? Health insurance. Get health insurance. It's not optional. In the US, everyone needs health insurance. Now, each policy will come with a deductible, an out-of-pocket maximum, what's covered at 100% and what is not covered at all. Some insurances have copays and in-network and out-of-network providers. Almost everyone does at this point, and other fine details. Okay. So they'll have things like hospital versus urgent care or walk-in clinic. They'll have different prices for different things, and whether you need to get a referral to go to a specialist. Every policy is just a bunch of rules. And if you don't follow the rules, it costs you a lot of money. So figure out what the rules are in your health insurance. Now, I did want to mention this. There's something called the No Surprises Act. So it passed recently, or it passed in the last few years, and it's come into effect. It bans surprise bills for most emergency services, even if you get them out of network and without approval beforehand, right? So it bans out of network cost sharing, like out of network coinsurance or co-payments for most emergency and some non-emergency services. That means you can't be charged more than in network cost sharing for these services. You know what? I'm going to skip all this. Here's what it means. Healthcare providers cannot send you large surprise bills, like they're called balance bills, for emergency services and some non-emergency services. And it also means in-network amounts apply at in-network locations. So let me tell you a story. All right. So I alluded to, I got my appendix out at 24. I was just married, right? And I got real sick, went to the doctor, had my appendix out. But before that, I had to get a CAT scan. And the CAT scan was in the hospital that was in network. But what I didn't know is that the people who were running the CAT scan clinic, lab, whatever, were out of network in an in-network hospital. And I got this huge bill for it. Now, this was a life-threatening situation. My appendix was about to burst, and I got this enormous bill for it because the people in my in-network hospital were actually out-of-network providers. Now, how was I supposed to know that? I don't know. I was about to die. So I got this enormous bill, which now the No Surprises Act says is not allowed. Okay. But I got this large bill. And what I ended up doing was I called up and said, no, that was an emergency. It should be all covered under emergency services. So I got a bunch of like thousands of dollars waived there, or renegotiated, recoded. But anyway, so over the years, just so you know, we've seen health insurance subsidies for different groups. So I just want to say, don't believe all the hype around health insurance costs. You might get a subsidy. We ended up getting one for a couple of years when Saver Street was just starting. And even without a subsidy, we found appropriate health insurance for our family that was affordable on our state's health insurance marketplace website. Now, it is super expensive for some folks, and you may or may not qualify for health insurance subsidy depending on the year, your income, current federal, state, and local laws. But you should still go in and get health insurance if you're not currently covered. Okay. I don't know how else I can emphasize that. So here are the places to get health insurance. Your full-time employer generally will provide health insurance. Okay. Healthcare.gov will send you to your state marketplace. So that's the third bullet, your state marketplace. You can either go directly there, or you can go to healthcare.gov, which will just send you there. Or you can go to a health insurance broker. Okay. And a health insurance broker will walk you through and help you find the best insurance for you. Okay. All right. That's it about health insurance. Go get it if you don't have it already. Life insurance. Let's dive into life insurance. Life insurance is financial coverage you buy for your loved ones in the case that you die. It's not for you. It's for your loved ones. Everyone dies. And if you die while you're covered by life insurance, your family doesn't have to add financial suffering to the emotional toll of losing you. Life insurance is meant to replace your income in the unexpected event of your death. It's a good idea to get life insurance if your income supports someone other than yourself. If someone's living off of the income you get from your work, you should have life insurance. You do not need life insurance if nobody relies on your income to live. Please understand that. Life insurance is meant to help people who are dependent on someone else's income. Okay. Anyone who makes income should be either self-insured, meaning that they have a lot of investments that are going to their beneficiaries, or they should have life insurance. And hopefully you start with life insurance and then you build up your investment portfolio and you don't need life insurance anymore. Okay. So we're going to go into those details. Here's how it works. You buy a certain amount of protection. You name your beneficiaries. So for me, it would be my kids. Well, actually, first my husband and then my kids. And then if you die, the beneficiaries get that protection. Buying life insurance just takes a few steps. It's a process, but it's worth doing. It's actually, it's about a month long, maybe a 2-month long process. During the buying process, you name your beneficiary. So it's all set up the moment your insurance starts. Now, lots of people I know say they get life insurance through their company, so they're fine. That's not true, because the moment you stop working for that company, your life insurance expires, and it's usually not as much as you need. Okay. So you should have independent life insurance from your place of work. Let's talk about risk. Okay. If you lose your job or change your job, you lose your life insurance. That's a big risk. That's not a good risk to take. It's not as easy to get a new job or like a good job as most people think. It can take a while. Okay. It can take a while. Maybe you've been there. And while you're looking for a new job, you could get sick. Don't rely on your job's life insurance to carry you. Also, if right now you're thinking, I'll just get life insurance if I lose my job. Well, let's talk about qualifying for life insurance. It is not super simple. I told you it was about a month or two process. Here's what they do during it. They look at your overall health, your BMI, any health conditions that you have. They open up your doctor's records. Sometimes, they ask for those doctor's records, and then you might not get a great rate. Age is also a significant factor. I don't know if you know this, but the body wears out after a while. Age is the number one factor when it comes to life insurance costs. Okay. The older you are, the higher the risk is that you die. Okay. Now that I've scared you, let's talk about how much life insurance you should have and what kind of life insurance to get. There's a whole large confusing world out there. People will try to sell you a lot of stuff you don't need. There's a lot of money in this, and I want you to know what you should get and what you shouldn't get. Okay. And a lot of people, they'll try to take your money because you love your family and want to protect them. So let's actually protect them. This is a get out of debt for good course. I don't want you to get scammed or to give your hard-earned money away to people who don't have your best interest at heart. So let's talk through exactly what you should be looking for here. Okay. Here's how much to get. You should get 10 times your income. Or if you do more of the childcare and the housework, then add up how much your work would cost to hire others to cover. Okay. I know this is a morbid conversation to have. I get it. This is like a terrible thing to discuss, right? My husband and I have this conversation about once a year. It's become like kind of funny, actually, to think about how much our jobs are worth around the house. My husband does more of the childcare. He takes the kids to school in the morning and watches them while I work 2 Saturdays a month. Okay. My husband does most of the laundry and a lot of the dishes and the cleaning. When he's gone, I have such a hard time. And now we hire a cleaner once a month. So that's already in the budget. The biggest thing here would be to hire someone to help with the kids in the laundry. Okay. I literally couldn't do all the cleaning, the laundry, the childcare, and still run the business I'm running. So we've decided on the cost for all of that for a 10-year span. We also calculated how much each of us is putting into our retirement savings and our future rate. So that figures into these calculations. Anyway, you can do all of those calculations if you want, or you can do the simple thing and calculate roughly what you think you need. I kind of like the rough calculation. I just think about everything we do in the house that I could do while grieving what I could actually do if grieving my husband's death. And then I figure out what it would cost to outsource what I couldn't do, which at that point in time would probably be everything. So anyway, he and I both have $1 million policies on ourselves, and we're both pretty healthy. He got his policy at 35 years old, and I got mine at 30 years old. Mine costs $29 a month, and his costs something like $47 a month. Okay. And that's the difference in 5 years. He's actually healthier than I am. Now let's talk about the types of life insurance you can find out there. There are 3 major types of life insurance: term, whole, and universal. I'm going to go into their descriptions and show you how each one plays out. I've run the numbers, and I'd like you to see all of this with your eyes wide open. You see, there are a lot of insurance salespeople out there, and they really want to sell you the insurance that pays them a ton of money every month. They're trying to pay their bills, so I don't actually blame them. But I do want to make sure you're making the right choice for you and your family. Okay. Term life insurance is the least expensive. It lasts for a chosen term of time, a term of time. So 5, 10, 15, 20, 25, or 30 years. And it pays out a lump sum at death. This type of insurance expires after the term is over. It's gone. And usually it'll have some sort of like annual escalation clause. So it'll say something like, after your term is over, we will charge, X amount per month for the next year. And then the next year after that, it'll be hundreds more per month, that sort of thing. So let's talk about 3 different ladies. Samantha is 30, and she finds a 30-year term life policy for $49 per month for $1 million. And that's because she doesn't shop around or go through a broker. Okay. And she doesn't really think about 30-year versus 20-year. If it were 20-year, it'd probably be a lot less. All right. Whole life is typically much more expensive, but it holds a cash value and lasts your entire life. We're going to talk about that with some real numbers here. Whitney is 30 and finds a whole life policy for $733 per month for $1 million. You see that difference there? $49 versus $733. Okay. Universal life is broken into 2 different kinds. There's guaranteed universal and invested, like indexed or variable universal. Basically, you get to choose what to invest it in. It's basically a term policy plus either a savings account or an investment account. Most people get the invested universal if they choose universal life. So let's talk about Jill. Jill's 30 and chooses invested universal life. She finds a $1 million policy for $733 per month, and she invests in the S&P 500. Remember, the point of life insurance is to help your dependents if you die early. So let's talk about Samantha, Whitney, and Jill. They're all 30-year-old women with the same birthday, health history, and risk to insurance companies. None of them smoke or skydive. Okay. Those are like risky things that increase your rates. Here we go. See all these numbers? Oh, I see it all getting blurry to you. Okay. Let's take a look at their numbers. Stay with me. This could mean the difference between you retiring a millionaire and being able to use your money and you retiring and making somebody else a millionaire. So let's talk about this. Samantha, she was paying $49 a month for her 1 million policy, 1 million 30-year term policy. Whitney, $733 a month. Jill, $733 a month. And don't worry, I have these as downloads for the session, so you don't need to write down all these numbers. Here's what I want you to see. All right, I'll pull it out. Look at these numbers. Samantha got her 30-year term. She didn't need a 30-year term, but she got it. She was disciplined and invested the difference in an S&P 500 index fund at a low fee brokerage. Okay. So she took the difference between the $49 and the $733 and invested the difference. Okay. By the end of her 30 years, she had more than $1.5 million in her investment accounts by investing just what Whitney and Jill thought they were investing. Okay. Now, Whitney got her whole life policy. She'll never lose the policy. It is there for her entire life. And she can borrow against the cash balance, but she has to pay back everything she borrows. I wouldn't like to have to borrow my own money, but maybe that's just me. So at the end, she's paid in $263,000 after 30 years. She's invested zero of that money, And what she has at the end is $510,000. That's about a third of what Samantha has. Jill, on the other hand, she got an indexed universal life policy. She invested in the S&P 500, just like Samantha. So why are these numbers so different? Well, it sounded like a good idea from the outside, right? But the fees on the universal life policy will eat up any good return. Her balance is even worse than the whole life policy. Okay. Oh, and she can borrow from it as well, which means she has to pay it back. Do you get the difference? Do you get the difference? My family keeps insurance separate from investments because we like to have control over the fees, the options, and the outcomes. So we get term life insurance and we work to build our own investment nest while we're under the term policy. Okay. So Samantha, after those 30 years, she had that balance, and that's not counting her investing anything else. Throughout her life, I'm sure she had the opportunity to invest in other things. That wasn't her full retirement egg. Okay. So let me ask you, what choice will you make? What would you rather do? Okay. Let's move on. Disability insurance, your favorite topic. This one's actually a little surprising, actually. Most times when I talk to business owners about disability insurance, they come back, or like lawyers who are self-employed or employed with smaller firms, they come back with a quote in hand and they ask me if I'm sure that that's what it really costs. Okay. And yes, guys, this one's really expensive. Don't skip this part. Did you know that over 1/4, 25% of all adults in the United States end up disabled in a way that affects what they can do? Yeah, that's why this is so expensive. It's a high risk. And I'm actually disabled myself. That doesn't mean I draw on disability insurance or that I live off the government. It means that I can't walk much more than a mile without my body swelling up like a balloon. Okay, that's all it means. It means it's limited the kinds of jobs that I can have. So let's talk about disability insurance. Disability insurance is a type of insurance coverage that replaces a portion of your income in the event that you cannot perform your job duties due to illness or injury. Okay, there are two different kinds. There's short-term disability and there's long-term disability insurance. And there's a huge difference between short-term and long-term disability. And it's all about the timeline. So let's just jump to a diagram. Disability insurance is all about protecting your income if you become disabled. This is a typical timeline for someone who needs both short-term and long-term disability. Let's say Brian breaks his knee. He needs a knee replacement and ACL reconstruction. I've known people who've needed that twice. It was awful. And you know, it could happen to anyone. I hope it doesn't happen to Brian, but let's say it does. He's unable to perform his job duties at that time. His job covers both short-term disability and long-term disability. Good for him. Good. So he got it through his job. Great. But he has to wait through this thing called an elimination period, which is usually 7 days long. It's the same with maternity leave in most places in the United States. So there's an elimination period before short-term disability kicks in. Brian uses his sick days or his emergency fund to get through the 7 days he isn't working before short-term disability starts. That's why we have you build that $2,000 starter emergency fund. Brian's short-term disability lasts 6 months and covers 60% of his income. That's incredibly normal for short-term disability. At the end of those 6 months, he's still recovering from his ACL reconstruction and still can't work. His long-term disability then kicks in. Brian's long-term disability coverage has a 6-month elimination period, which we just covered with short-term disability, and it can last up to 5 years, and it covers 65% of his income because he opted for the increased level of protection. Always do that. He doesn't need it for all this 5 years, though, and he's back to work after 9 months. Excellent. That's how all of this works together. Now let's talk about coverage, what your options are, what it breaks out to be, and what's worth having. Short-term disability. I know this is a long lesson. Stay with me. Short-term disability insurance protects about 60% of your income for 6 months to 2 or 3 years. Okay. You have different options. They cost different amounts. Short-term disability usually kicks in a week after the event that caused your disability. Many women use short-term disability to help cover their maternity leave income gap in the United States. Brian's short-term disability covers just 60% of his income, and his company isn't supplementing to help him out. He's not able to work. He needs to supplement his income himself or live way less expensively while he's recovering from his surgery. If Brian makes $100,000 per year, then he's now getting $60,000 from short-term disability after his accident. Not in a lump sum. It means he's getting 60% of what he normally did. So if he was bringing home $5,580 per month, now he's bringing in $3,400 monthly on short-term disability. Okay. Long-term disability, on the other hand, kicks in 3 to 6 months after your disability starts and lasts anywhere from 3 to 5 years, or even until the end of your disability. Now, those kinds of policies are really expensive, the ones that last until the end of your disability. And they cover your lost income anywhere from 50% to 65%. All of these timelines and percentages depend on your policy. Okay. So it's important to know what your policy covers. Aim for a 65% replacement policy for long-term disability. Brian opted to pay $8 more per paycheck to get 65% instead of the 50% coverage. So now he's bringing in almost $3,700 per month until he gets back to work instead of bringing home like $2,500. Okay. It makes a big difference. All right. So what's the cost and how do you get it? Here's the rub. Both short-term and long-term disability insurance cost 1 to 3% of your annual income each year. So that's why we tell you to dump. And that's why I'm telling you now. Once you're out of debt and you have your full emergency fund in place, if you're paying for short-term disability and your company isn't the one doing it, dump it. Okay. You could be putting that 1 to 3% of your income into retirement or into investments. Long-term disability, on the other hand, will follow you until you stop working. That will be 1 to 3% of your income throughout your working life, unless your employer covers it. That said, even though it costs a lot, it is a solid insurance to have. Many folks end up disabled and need to draw from it. In order to make sure you're properly insured, please reach out to a local insurance agent near you or to a company like Policy Genius. I don't know why. I just love Policy Genius. They're really, really good. They can help you find the right disability insurance for your situation. And no, they're not paying me to say that. I just like them. Okay. So here's this example, right? If you're employed by a company, take a look at your benefits. I was employed by a large company for over a decade, and I received a mixture of short and long-term disability insurance. My short-term disability insurance was for 60% pay and came at no cost to me, zero cost to me. Take a look. If you receive free short-term disability coverage through your employer, there's no reason to dump it ever. Keep it. My last employer provided long-term disability coverage up to 50% of my income. And I could buy an insurance rider. That means an extra little bit of coverage, right? To cover my income up to 60%. So I took it. Okay. I think it cost me like $25 for the whole year. It was a few dollars every month. And if your employer covers disability insurance for their employees, it probably will cost a lot less to you. So go with that option instead of getting your own. All right. So disability insurance, who needs it? If you rely on your income, then you need disability income, then you need disability insurance. If you can get disability insurance for free or very low cost, then take the insurance. I'm sure after talking about all this, after looking at the timeline, you already know what kind of policy you need, short-term or long-term or both, and why. The goal here is eventually for you to be completely self-insured. But most people taking this course, you're not there yet. And I get it. That's fine. If you do not have a 6-month emergency fund in place, then you should have short-term disability insurance. If you have a 6-month emergency fund, then you do not need short-term disability insurance. If you're working and bringing in an income that you depend on to live, then you should at least have long-term disability insurance. That's basically everyone who works for a living. Okay. Disability insurance only covers a specific percentage of lost income. It will not work. It will not work. Oh, there we go. I have it all on the screen. Disability insurance will not work if you don't already have an income. It won't replace income you don't have, which means that stay-at-home parents should not get disability insurance. I know you do a lot around the house, but disability insurance doesn't work that way. It will not help you if you're not making an income. So here we go. Long-term disability options. There are a few different coverage options for long-term disability, and it can be confusing, which is why we're going into this. So let's iron out some details. You can get either any occupation disability insurance or own occupation disability insurance. Okay. Any occupation or own occupation. The first one's just called occupation. The first one only provides benefits if you can't work any job. Okay. Any job that you're reasonably suited for because of injury or an illness. This is hard to prove and hard to receive a benefit for. It also costs less. Own occupation disability insurance has a few levels to it. This is really for those who have specialized jobs like pop stars, opera singers, politicians, CEOs, actors, dentists, surgeons, models, astronauts. I think you get the picture. Actually, singers and musicians who rely on specific talents like their voice, they can insure parts of their voices and hands and bodies with special, extremely expensive insurance policy. But that's just for huge stars like Lady Gaga and Michael Bublé and John Mayer, So, and now you know a little bit more about me. Others who rely on a specific field and have high-powered careers in that field, they should get own occupation long-term disability insurance. So like lawyers should get own occupation disability insurance because that is a specific profession and it pays a lot, depending on where you are and what you're doing. But that's own occupation disability insurance because if you get a TBI, a traumatic brain injury, and you can't do your own occupation, well, you've just lost years and years. So you should get own occupation disability insurance. Okay, it's a type of long-term disability insurance. Here's the bottom line, guys. Build up that 6-month emergency fund after you pay off all of your consumer debt. Become debt-free, build up your 6-month emergency fund so you don't need short-term disability, and then get the kind of long-term disability insurance that you need based on your occupation. Okay, I'm done with disability insurance. Let's move on to car insurance. Oh, all right, let's cover car insurance, what kind of coverage to get, why, and how to get it. So it goes without saying that anyone who owns a car needs car insurance. I know it's not mandatory. It's not legally mandatory in some states, but it is in many states. If it isn't the law in your states, you should get it anyway. Driving a car is one of the biggest risks, biggest risks, both for medical costs, which we know can be in the hundreds of thousands of dollars, or for property costs and for vehicle replacement costs. So get it. Okay. If you own a car, you are responsible for expenses and liabilities that happen because of that car or to that car. Damaging another car, hurting a person, causing property damage, or even killing another person could all happen because of the car, and you're responsible. You do not want to be sued for everything you're worth and more because of an accident that happens with your car. It could legitimately ruin your life, and it has to many people. I mean, cars are dangerous, guys, but let's make sure it doesn't ruin your financial life if anything horrible happens, okay? So protect yourself. Here's the kinds of car insurance to get. Car insurance coverage has 3 essential parts. All right. Liability, comprehensive, and collision. Let's go into each right now. Liability coverage is designed to help you if you're in a car accident that is deemed your fault. Okay. So you hit someone, you're at fault, and liability coverage covers the costs or most of the costs if you're in an accident that you cause. It pays for the other person's medical and auto repair costs from the accident. Basically, if you crash into someone, then liability coverage covers their ambulance, their hospital stay, and the car repairs that you're responsible for. Okay. These can be high ticket expenses. So get as much liability coverage as you can, at least $500,000. Now, liability coverage will come to you with 3 numbers. We're going to look at those in a moment. And it can be confusing at first. You're looking for $500,000 of liability coverage. So, like, what do these 3 numbers mean? They'll look something like 250, 500, 250. That means the policy has $250 of coverage for bodily injury per person, $500,000 of coverage for bodily injury for the whole accident, and $250,000 in coverage for property damage for the accident. That may or may not be enough. We'll get to that in a moment, but that's the kind of liability coverage you should be looking for in auto insurance. It's not expensive. This is not expensive. People don't get in accidents all the time. Okay. So this is what it looks for. It's that $250,000, $500,000, and $250,000. Or it can look like this: 300, 600, 300. You see kind of how it works there, right? And I've seen this too. Some people who live in Washington, D.C. or live in high cost of living areas like Boston, Massachusetts, San Francisco, they get this because property damage and medical treatment is a lot more expensive in those areas. So they'll get 500, 1 million, 500. Okay. Okay. Car insurance, comprehensive coverage. Okay. Comprehensive coverage will cover the cost of replacing or repairing your car if something not accident related were to happen to your car. It's another must-have in your auto insurance policy. Comprehensive coverage covers the cost of replacing or repairing your car if something were to happen to your car. All right. So if your car was stolen, vandalized, caught in a natural disaster, had a tree fall on it, the cost of replacing your car would be covered by comprehensive coverage. This one's not expensive either. Think of it as comprehensive. It rounds out the kinds of expenses you can have from owning a car, at least when you pair it with collision coverage. So let's go into that. Last one that you need. Okay. Well, sort of. There's another one I highly recommend, but it's not totally necessary, but I highly recommend it. So the last time of coverage you absolutely need is collision coverage. Collision coverage covers the cost to repair or replace your car if you're in an accident, regardless of who's at fault. Okay, so if you need your car and you want to make sure that you get your car replaced, you need collision coverage. So get collision coverage because accidents happen. Liability coverage only covers the cost of the other person's car if you're at fault. Collision coverage covers the cost of your car if you're in an accident. Now there's another little like add-on that you can get for car insurance. It's called uninsured or underinsured motorist protection. And I highly recommend this as part of your auto insurance package. Here's why. Uninsured or underinsured motorist protection usually has 3 pieces: bodily injury per person, bodily injury per accident, and property damage, just like liability coverage. So that 500, 1 million, 500, or 250, 500, 250, just like that. Okay. So let's go through an example. And before I show it to you, let me tell you that this is usually how it's laid out by a good auto insurance broker. I'm not a broker. I'm not here to sell you anything like that. But they will talk you through what kind of coverage you should have, what you currently have, the cost difference between having some coverage versus others. I'll also go into how to decrease your auto insurance costs, but a really good insurance broker will help you as well. Always go through an insurance broker. You'll save thousands of dollars in your life, if not like every year. Okay. So let's go through a real example. This is a real example from one of my clients. And I'm so excited that she changed insurances and went through a broker. So let's break it down. She has 3 cars, which you see up there: a Honda Odyssey, an Acura RDX, and a Lexus GS. This policy is to insure 3 people. The new insurance takes a 26-year-old male, her oldest son, off the policy. Okay, so you do have a 26-year-old man coming off the policy. The first 3 amounts you see here: bodily injury per person, per accident, and then property damage. Okay, bodily injury per person, accident, property damage, liability. Okay, that's the liability coverage we talked about. Then it also has income loss protection, which we didn't talk about, and medical payment protection. The income loss portion covers the other person's income loss. The medical payment, so if they get into an accident, it covers the other person's income loss and medical payments. Okay. All right. The medical payments protect the person in your vehicle if you cause an accident. Okay. You'll also probably if you're looking at this closely, you'll notice a few other things in here. She's getting some good uninsured and underinsured motorist coverage. That's excellent. That's really good. Okay. It's just like the liability coverage and the layup: medical per person, medical per accident, and property damage. Okay. She also has, if you look there, comprehensive coverage. So replacing or repairing her car in the case of vandalism or theft or something like that, a tree falling on it, her deductible is $500. And every insurance has some sort of deductible. It's what you pay before their payments kick in. Then she has collision coverage with a $500 deductible. That'll replace or repair her car in the case of an accident, whether she causes it or someone else does. There's also towing and labor for retrieving the car's rental reimbursement, which isn't super necessary, but is nice. And I didn't include that here because I ran out of room to show you guys, but she had all of that on her insurances. So maybe you've already seen it, or maybe you're totally lost by now and you're not paying attention. But look at the difference. Look at the difference in her insurance premiums. It's nearly $5,000 per year. Okay, that she's saving. That's incredible. Look at that. Okay. Should we get to how you can save on auto insurance? Okay, let's do that. Let's get to how you can save on it. And I have a whole other video on how to save on it, like really save on it. This one's just a little bit of a primer. So here's how to save on car insurance. Increase your deductible. Okay, that deductible we just talked about. If she put in $1,000 of her own money, her car insurance would be lower instead of $500. Okay, so as a refresher, deductible is the cost you pay before your insurance kicks in to cover anything. If you have a lower deductible, then you'll pay a higher premium. So the cost of your insurance will be more. If you have a higher deductible, you'll pay a lower premium. Because you have an emergency fund, go for a higher deductible and a lower premium, but do calculate it out. Okay, if you'll only save like $80 per year by increasing the deductible from $50 or $500 to $1,500, that's not worth it. It would actually take like 10 years to make up that difference. So it's not worth it. There are other ways to lower your premium. Okay. If you're married, served in the military, have a clean driving record, don't drive much, own your own home and want to bundle it with your home insurance, the list goes on. We have a handout as to what kinds of discounts to look for and ask for in order to lower your car insurance premium. So how do you get the right auto insurance coverage for you? Shop around, go through an insurance broker. National brands are pretty good for auto insurance, but your best bet is really to contact a local insurance agent and find coverage that best protects your family at the lowest premiums to you. They'll know, based on your situation, where to find the lowest premiums and the right fit coverage for you and your family. Every single one of my clients has gone through a broker and they save a ton of money. Now, I could make this really long, but nobody wants that. So I've made a bonus video on how to save money on car insurance. Watch it if you want to save money. Okay. Homeowners insurance. Homeowners insurance covers expenses you could potentially have in your home if something unexpected and damaging happens to it. If you are at all concerned about your house burning down or being flooded or rising waters from outside or even like being flooded from within your home. One of my clients had a pipe burst the other day and insurance covered it. One of the largest assets people have is their home. If you want to protect that from any major risks that might come your way, homeowners insurance reassigns the financial risk of your house being damaged to the insurance company. That means if a tornado were to swoop down and destroy your home and you were insured against it, you wouldn't have to worry about the cost of rebuilding your home and the cost of everything that's in that home. You could actually focus on your family, your immediate living situation, let your insurance take care of funding the disaster recovery. Okay. Everyone who owns a home needs homeowners insurance. Everyone. It's not required by the law, but it's the smart thing to do. There are 4 types of coverage: dwelling, personal property, liability, and additional living expenses. We're going to be going pretty quickly, so pull up your pants and let's get going. I'm going to be doing this real fast. I'm losing you here. I can hear it. The first, dwelling coverage, is pretty simple. Dwelling coverage is the amount of money it would take to rebuild your home. Dwelling, it's the thing you live in. If something were to happen, okay? Your insurance agent will be able to help you get the right figure. All right. They figure out how much it would cost to rebuild your home. Personal property is all about what you have inside your home. It's the things you own in your home. Okay. Think about every room in the house, from furniture to rugs to toys to electronics to even food in the fridge and the freezer. Calculate how much all that stuff would cost to replace and round up. If you have some high ticket items like jewelry or expensive paintings, then ask your insurance agent if you'll need an additional policy specifically for them. Okay. You might need a rider for that sort of thing, for really high ticket items. I know I do for my ring. Okay. For jewelry. Liability coverage it's essential for any homeowner. This basically covers you if someone gets hurt on your property and decides to sue you. And that happens more often than you think. It covers that, like, slip on black ice. It covers a dog bite. It covers breaking a leg after trying to jump your fence. Really, people will do that and then sue the homeowner for having a fence. So these policies, liability policies, will cover you up to a certain amount by as much as you can. All right. Some companies will go up to $500,000 in liability coverage. Just know that some policies won't insure you against trampolines or certain types of dogs. And I know that's unfair, but I'm sorry. I can't go into insurance companies and change it. I'm just telling you about it. Now, additional living expenses. That's like having a huge emergency fund. Okay. If some catastrophic event were to wipe out your home. So additional living expenses, it reimburses you for the added cost of living without a home, the added cost. That means it's the additional cost over and above what your normal cost of living is. And they will go into those details. Okay. So if you usually spend $600 per month on food, but it now costs $1,000 per month because you don't have a kitchen and you're eating out all the time, additional living expenses, that policy within your homeowner's insurance would reimburse you for the additional $400. So your insurance agent, your broker, will help you decide how much you need. Okay. I know I talked about insurance agents a few times. Finding the right insurance for your home is difficult and it can be confusing. Your home, your stuff, and your budget is unique to you. My best advice here is to find a local independent insurance agent. Google it, who can help you. They are brokers who try to find you the right coverage for you at the lowest price for you. They're local, so they know, like, the kind of crazy extra homeowners insurance coverage you might need, like extra flood insurance or mudslide coverage in some areas. I use an independent insurance agent from a local church, and I highly recommend Murray and McDonald for anyone in Massachusetts. There's nothing like going through a local insurance agent because they know things like the likelihood of tornadoes and things like that. It saved us hundreds of dollars each year versus trying to find a policy ourselves. Okay. Okay. I'm just going to skip all this. Okay. Because we went through it. And this is all the things that I said. So I hope you were listening. Okay. Go through an insurance broker, do it. Renter's insurance, I'm going to go through this real quick. It's just all the stuff that you have in your apartment or your house that you insure. It costs about $15 a month, 12 to 40. I've never seen it around 40, but that's what the internet said. Okay. It only covers your personal property and you should get a minimum of $10,000 coverage. And the reason is the owner of your home, if you're renting, the owner of your home is not insuring what you have in it. They're just not. Their policy will not cover that. It is a separate policy that insurance companies provide. So get it. So if somebody breaks in, they steal your stuff, if the house burns down, you have money to replace your stuff. Okay. So let's review what we covered in this lesson. We covered why insurance is one of your best defenses to stay out of debt for good. We covered the basics on health insurance, life insurance, disability insurance, car insurance, homeowners insurance, and renters insurance. And now I'm going to give you some homework because I know this video is long. Make a chart. I have a chart, download it. What kind of insurance do you need? And what should you review? When was the last time you got that insurance? Then call and email an insurance broker. Attend a consultation to help you figure out your next steps to replace coverage you have or get coverage you need. And number 3, do not, I'm glad you made it to the end, do not dump insurance until you have replacement coverage in place. That includes life insurance. This whole lesson is about making sure you have the right insurance coverage for your situation so you can keep the money that you work so hard to have. It is your best defense, guys. It's your best defense. If you have questions about this, please join the group financial coaching sessions. We're here to help you get out of debt for good. So before you start the next lesson, you should have a consultation on your calendar with an insurance broker or 2, because they actually have different insurance companies in their like little online index thing. So you might want to just consult with a couple different brokers. Anyway, also, you should fill out that chart to help you plan the kind of insurance you need to either review or get. Okay. I will see you in the next lesson. The next lesson is the last lesson. It's all about marriage and partnerships. And I'm very excited to see you there. It is one of the hardest lessons, but it's so worthwhile. All right. See you there. Bye.